HDFC Life Click to Invest. Is it a good investment plan? Should you invest in this plan? Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to create long-term wealth by helping them take right financial and investment decisions. HDFC Life Click to Invest. To analyze this policy, first we need some basic information. What are all those basic information? The key features of this policy. Let us see the key features of this policy and understand those key features, and then we can analyze. HDFC Click to Invest is a ULIP, unit linked insurance plan. That means this policy will have two components. From the premium we pay, in the first component, the money will go towards buying life cover for you. Balance component will be invested in market to generate long-term wealth. When I say the money will be invested in market, it can be in stock market, it can be in money market. So the returns will be based on market performance. Now, as the returns are based on market linked, you will not get any assured return. So this is not a guaranteed return product like our regular endowment money back policies. Let us see the basic structure of this policy. In this policy, there are options for you to pay a single premium and wait for 5 years or 20 years. And after the policy term of 5 years and 20 years, you will be getting a maturity value. The second option is you can choose the policy term as 10 years to 15 years or 20 years. But you can also choose to pay the premium paying term as 5 years, 7 years or 10 years. Say if you are choosing the policy term as 20 years and premium paying term as 10 years, that means for the first 10 years you will be paying premium. Next 10 years you will be waiting. So the 20-year policy term will be over. On maturity you will get back the maturity value. Another option, a regular premium option. You can choose the policy term as 20 years and every year you will be paying premium. End of 20 years you will be getting back the maturity value. And this particular policy has got both death benefits as well as maturity benefits. The maturity benefit of this policy depends upon the underlying funds in which this fund is getting invested. Yes, this fund has got multiple fund options. Equity plus fund, diversified equity, blue chip, opportunities fund. These are all predominantly equity funds. They can have 100% exposure to equity. Balanced fund is kind of 50-50 moderate riskier fund. Bond fund, conservative fund or fixed income oriented funds, they'll have higher exposure to fixed income, but they can also invest in equity. Whereas secure managed fund, the last one, is 100% fixed income oriented fund. It will not at all invest in stock market. So depends upon your risk appetite, depends upon your return requirement, and depends upon your market outlook. You can choose to have your own customized asset allocation. Yes, doing asset allocation based on that, dividing your investment amount in different fund options is possible. You can do asset allocation. You can also do asset allocation rebalancing periodically through this policy. Now, as we have understood the key features of this policy, we can start analyzing this policy. We can analyze this policy only if we understand the benefits of this policy, right? First, let us analyze the benefits. There are two types of benefits from this policy. Number one, death benefit, and number two, maturity benefit. First, let us see what is the death benefit the nominee will receive in case of the unfortunate death of the policy holder. The death claim amount will depend on the highest of any of these three values. Yes, three values. The first value is the fund value as on date. The investment component will go into different funds as we have seen earlier. So what is the investment value based on the fund performance? That is the first value. Second value is 105% of the total premiums paid so far. That is the second value. Third value is the guaranteed sum assured. What is the life cover or sum assured guaranteed in this plan? Out of these three values, whichever is higher, that will be given to the nominee as death claim. As we have understood the death benefit of this policy, it is time to move on to the next benefit. What is the next benefit? Maturity benefit. Maturity benefit, it is easy for us to understand by looking at an example. Let us take an example. An investor is choosing to pay 1 lakh premium every year for 10 years and the policy term is 20 years. That means he will pay 1 lakh for first 10 years. Next 10 years he will wait. End of the total 20 year period, he will get back the maturity value. In this example, the investor is ready to take a highest risk. So he is investing 100% in equity funds, right, which has got a higher risk so that he can expect high returns. Now let us see, after taking high risk, what kind of return this investor is getting. This is the illustration from HDFC Life website. After doing all the calculation, after doing all the charges, return expectation, it works out to 6.55% net yield. This policy gives you 6.55% net yield. The investor is paying every year 1 lakh for 10 years and waiting for another 10 years. At the end of 10th year, the maturity value works out to 25 lakhs 99,000. It is almost close to 26 lakhs. You are investing 10 lakhs and waiting for another 10 years and it is becoming 26 lakhs. When we calculate the internal rate of return, it works out to 6.55%. Today, the risk-free rate of return itself is 5 to 6%. Your regular FD can give you 5 to 6% risk-free return. So 6.55% is close to your risk-free return. But this policy takes risks and invests in market. It is market linked. Even after taking risk, it is not able to generate risk premium return. It is generating only the risk-free return of 6.55%. Why do we take risk and invest in market? Because we want to beat inflation. Will this 6.55% help us to beat inflation? No, will not be possible, right? So we have understood both the benefits, death benefits as well as maturity benefit. In order to evaluate this policy, we can do a simple approach of comparing and contrasting with few other investment products. We can take one risk-free product, PPF, then we can take a risk premium product, which is mutual fund ELSS. It also invests 100% in equity, invests in market. So let us compare this so that we will get better clarity. One reason why this fund, even after taking risk, it is generating poor returns is charges. Like any other ULIP, this fund also has got a lot of charges charged to investors. So in order to compare and contrast this policy with PPF and mutual fund ELSS options, let us divide the insurance component and investment component separately. Just this division we are doing only for the first year premium. Let us say the policy in the example what we saw, the investor is paying 1 lakh premium for 10 years and waiting for another 10 years and getting a maturity value at the end of 20th year. Throughout these 20 years, the policy holder also gets 10 lakhs as life cover. In this case, we have assumed the age of the individual as 30. So out of the first year premium, right? Out of the first year premium, the investor is paying 1 lakh as premium. In this example, we are taking only 70,000 towards the investment capital. Balance 30,000, the investor is taking a single payment term insurance plan, which will give him a life cover of 10 lakhs for 20 years. So to get the same life cover from the insurance, from term insurance, same life cover. What is the life cover available in Click2 Invest? We are simply taking it as a separate term insurance policy by paying 30,000 rupees as the single premium for entire 20 years. So in this slide, what you are seeing is 30,000 paid towards term insurance for buying a separate single premium term insurance life cover. Balance 70,000 and future premiums of 1 lakh every year will be invested in PPF. That is what we are going to see. Now let us see the next slide. PPF and ELSS mutual fund. The total term is 20 years. In the first year premium, we have taken 30,000 rupees for life cover. It is an one-time payment. That's all. Balance 70,000 and 1 lakh every year. So put together 9.7 lakhs is invested in PPF or ELSS mutual fund. First, let us see PPF column alone. 9.7 lakhs we are investing totally in PPF and waiting for 10-year period. End of the term, the maturity value, it works out to 26.5 lakhs. It gives you 7.1% return today. Remember, the return given by HDFC Life Click2 Invest is 25 lakhs. Here you are getting 26.5 lakhs. And the very important point between HDFC Life Click2 Invest and PPF is PPF gives you guaranteed assured risk-free return. Click2 Invest return is not guaranteed and not assured. It is risk premium return. You are taking a risk. The money is invested in market. It goes through ups and downs. It is not there in PPF. Without taking any risk, a government-backed assured return scheme like PPF is able to outbeat HDFC Life Click2 Invest. Now let us see how it works vis-a-vis ELSS mutual fund, a risk premium investment. Same concept. First year alone, 30,000 rupees goes towards term insurance for buying a 20-year life cover for 10 lakhs. Balance 70,000 and 1 lakh every year for 9 years. Put together 9.7 lakhs is invested in ELSS mutual fund. We are waiting for another 10 years. End of 20th year, what is the expected fund value? At 12% conservative return based on the past assumptions is what we have made. And this 12% is market related. Based on market performance, it can go up and down. But historically, 12% is what ELSS funds have delivered. It works out to 55.5 lakhs. The maturity value works out to 55.5 lakhs. This 55.5 lakhs is the pre-tax return. Even if you accommodate tax, it works out to 51 lakhs. Post-tax return from ELSS mutual fund is 51 lakhs. So when you compare between 25 lakhs and 51 lakhs, there is a huge difference in mutual fund ELSS. So mutual fund ELSS, it is a very flexible investment. You can choose to invest in multiple ELSS funds and generate returns. Compared to Click2 Invest, you don't have that flexibility also. So in mutual fund ELSS, you are investing in market, you are taking a risk, you are able to beat inflation and get risk premium return of 12%. So if you are a risk-taking investor and looking for a better risk-adjusted return, I think mutual fund ELSS seems to be a better option for you. So should you invest in HDFC Life, Click2 invest ULIP? Number one, it is not giving you a risk premium return. It is giving you a poor risk adjusted return of 6.55%. And number two, it has got a huge charges. And number three, it is not helping you beat inflation even after taking risk. So it is a clear avoid. You can avoid this HDFC Life Click2 invest ULIP. If we have to avoid this, then what is the alternative option? As we have seen it in the example, you can choose to have a combination of term insurance plus PPF. If you are a risk avoiding conservative investor, choose a combination of term insurance plus PPF. If you are a risk taking investor, you are an aggressive investor, then in that case choose a combination of term insurance plus ELSS mutual fund schemes. If you are a moderate investor who is not willing to take 100% risk, also not willing to avoid risk, you want to be in between, then in that case choose a combination of term insurance plus PPF plus ELSS mutual fund. In this way you will be able to do a better asset allocation. You will be able to do. We have done a detailed research analysis of this particular policy and wrote a detailed elaborate blog post which is available in our blog. The link to that blog post is available below this video in the description box. You can click and read. If you have any specific questions related to this particular policy or any other investment options, we encourage you to take a free appointment with our financial planner. The link to the free appointment registration is given in the description box. Do you want to attend insightful investment webinars? Yes, we organize regular insightful investment webinars for our viewers. The registration link for the next free live webinar is available in the description box. You can register and get benefited. Last but not the least, if you like this video, please click the like button and share it with your friends. Please subscribe to our YouTube channel so that you will not miss any of our future videos. Thank you. Bye.